Thank you so much for joining today's webinar entitled Planning for Your Dream Retirement. My name is Keeley Simpson, and I'm joining you from Toronto, Ontario. I've been with BMO Nesbitt Burns for actually it's going to be 17 years this April, so it's been a while. And I've had many opportunities to present both with a webinar and seminars for the McGill Women's Alumni Association. So thank you for inviting me back again. I just thought I'd give a little bit of background about myself, and then I'll go through the agenda and then some of the quotes that I have at the beginning of the session. So again, my name is Keeley Simpson. I'm a wealth advisor and portfolio manager based in Toronto, Ontario. My team is comprised of myself and my business partner, Lee Rohrbeck. And together we manage about 215 households. Just on a personal note, I have 4 small kids. My oldest is 5 and my youngest is turning 1 in a couple of weeks. And I also have 2 dogs, so things are pretty busy at home. And one of the primary reasons that I actually started these educational series specifically for women, it's a little bit personal, but it's because actually my mom, she was a business owner and she became sick, kind of like out of nowhere many years ago. And it became really apparent quite quickly that she didn't have the right advice from her advisor at the time. And so I kind of made it my mission to try to educate women as much as possible, educate business owners, educate women about personal finances, how to plan for kind of the worst case scenario, and hopefully come out ahead. If my mom had had the right advice at the time, things would have worked out really differently for her and for my parents. So I think it's just really important that you're taking, you're really all taking the right step today just to get educated, to find out more information, and hopefully you'll walk away today with, a couple of aha moments, or like just little nuggets of information. So also, just a quick note, if you did attend last week's session, which was more of like a beginner session, you'll find that today the slides are quite similar. Until we get to sort of the meat of the presentation. So, bear with me if you'd like to learn more about the retirement planning aspect of the session. The beginning is quite similar, just because it is, we are talking about some of the unique challenges that women face in planning for retirement and what investing is like for women. And we are going to start out with a quiz. We're going to go through what the 9 biggest retirement mistakes are and how to avoid them. We're going to build out a net worth plan for you. So if you have a piece of paper and a pen handy, please get that ready. We're going to talk a little bit about what responsible investing is. We're going to talk about selecting an advisor. We're going to review some of the resources that I'm going to talk about during today's presentation. And then I also have a survey at the end that you can just take your phone and point your camera to the screen. It's a QR code and it'll pop up with the website, and it'll take about not even a minute to complete. So that's at the very end. So I'd like to start off in these presentations to talk about money is genderless, but investing for women is different. And what I mean by that is that women generally, and obviously this is just a generalization, is that women just tend to be a little bit less confident in their knowledge about finances than men. And this uncertainty also extends to retirement planning and just knowledge in general about financial products. It's just a byproduct, I think, that over the many years, men have generally taken on that role in the household. So it's really great that you're all here today just to learn a little bit more about personal finance, since it's not even covered, like in university or high school. So it's really great that you're all here today. And then just a quote on planning. So planning is bringing the future into the present so that you can do something about it now. And it's just basically, having a clear vision of where you want to go really helps to try to get you there. So there's many steps that need to be taken to ensure a clear retirement plan, and that's what we're going to talk about today. So I have a little quiz. So, well, just in general, if you just want to maybe talk to yourself for a minute and just answer some of these questions. So what are your goals and what are you doing to reach them? And what I mean by that is, like, is retirement your goal right now? Is that what you're aiming to plan for? Do you have a major purchase? Are you planning for a kid's education? Do you have legacy plans? Estate planning is usually a pretty big one. So on a monthly basis right now, to maintain your current lifestyle after retirement, how much capital will you need to have saved? What are all of your sources of retirement income going to be? How much income is each of them going to provide you with? What percentage of your gross income right now are you currently saving on a month-to-month basis? And what does that work out to of your net income, so after taxes? And what was the return on your investments or your savings last year, your return on your investments? So women, just based on the many studies that have been done, it can be basically concluded that women generally like to be very informed and knowledgeable before they invest. As women, we do tend to communicate differently, and we have different life experiences. So we also tend to be a little bit more risk averse than our male counterparts. Some of the unique challenges that women face in planning for retirement is that traditionally it's been presented as a couple experience, which we're seeing now more and more that that's not the case. It's very much often lived alone. Women tend to have also worked decreased hours, whether that's leaving the workforce to take care of young children, perhaps you've had to leave the workforce to take care of your own parents. Generally, that all kind of falls on women. And generally speaking, in the pandemic, that also fell a lot on women trying to manage their family at home and also their careers. Women are living longer. They tend to have a little bit less confidence when it comes to investing. And generally speaking, with the non-financial aspects of retirement, women tend to come out ahead. So men and women complement each other in that aspect. So this is a retirement expense worksheet, which would be handy to have. It's an Excel spreadsheet that I can send out after. On the survey, if you'd like to receive this spreadsheet, just click that this is what you would like to receive. So it's called the Retirement Expense Worksheet, and it's in the spreadsheet you can actually put in your current expenses that you have on a month-to-month basis, and whether those are fixed or discretionary, you can differentiate between the two. And then let's say your retirement age is going to be 65 or 68. You can manage those expenses in this spreadsheet and basically see what they're going to amount to when you do retire with inflation. Because inflation is obviously a really big aspect when it comes to that planning piece. And obviously we've seen inflation at historical highs over the past year. And that's why the central banks have increased interest rates as quickly as they have to try and get that inflation number under control. So what does retirement look like to you? So again, just a little bit of redundancy here, but have you considered how the following are going to impact you? So living longer, it's no longer a set point in time. The sandwich generation, declining pension. So a lot of companies now are not, giving employees, not giving, but allocating employees their top 5 years of earnings. Now it's usually employees contribute to their plan as well as the employer. And we do see a lot of clients right now retiring with some debt. That's actually been the biggest shift I've seen this past year, because interest rates have increased as much as they have. Clients now are really looking to reduce any kind of debt payments that they have, because it used to be, that interest rates were basically 0%, and so it was kind of free. So retiring with debt obviously didn't really matter that much. But now what we're seeing is clients are aggressively trying to make sure that whatever amount of debt that they have, that they're paying off. So we're trying to figure out ways to make that happen for clients right now, especially if they've bought a cottage or second property, or there could be just a number of factors as to why there would be some extra debt that had been accumulated. But generally, we're trying to figure out ways to reduce that debt right now. So again, so women are taking care of their parents. Women may leave the workforce for a longer period of time, which we talked about. Adult children returning home, caring. Some clients now are caring for their grandchildren so that their daughter or son can work. Outliving your spouse, so becoming widowers, getting a divorce. A lot of clients also have come to me and said that they're getting divorced now that that both parties are retired, and it's an empty nest at home, that they're just finding that they're not aligned the way that they used to be. So divorce later on in life is quite common. And then working longer, if that's something that you're interested in, like how much are you going to work, and then in what capacity. Some of the, I guess, the old adage, traditional rules of thumb or retirement myths are that I am fine, I have a company pension plan, which again, that used to be the case many years ago, but now the onus really is on you to help, fund your own retirement. I need to have 70 to 80% of my pre-retirement income, and that again just really depends on what inflation number you're working with when it comes to the plan. I've heard I need to save $1 million, which again, all the variables that go into a plan. So what are your monthly expenses? And then I will be fine if I only withdraw 4 or 5% of my savings once I retire. I do like that rule of thumb because as long as your investments are earning more than inflation, so right now that would be quite high, withdrawing only 4 or 5% a year from savings once retirement comes along, that could be a good one to work with. As long as your investments are basically giving you a higher return than inflation right now, that could be a good one to use. But I guess what I'm trying to say is that there's really no one size fits all solution. So it's really important to plan ahead. So I put in here some of the biggest retirement planning mistakes that we see. So I think one of the important things that came out of the pandemic and also came out of the 2008, 2009 market crash is that you kind of just need to build out a worst case scenario financial and retirement plan. So what happens if you go to retire and the markets go down substantially? What does that do to your retirement plan? What happens if inflation is really high for a long time? How does that impact your plan? Then just going down to the next part, so making sure that you can outlive your wealth, so ensuring that your nest egg is going to last you 30 plus years. And again, I just mentioned it, but failing to account for inflation, like that variable is just really, really important. Because if you're going to the grocery store, you're going to fill up your gas tank, and it's costing more and more money every month, but the monthly income, is not keeping up with those expenses, then that means that you may have to draw on more of your capital than you were planning on, which means that the nest egg may last for a shorter period of time. So it's just really important to account for inflation when you're doing your planning. And then a lot of clients always ask me, how and when do I maximize my CPP benefits? So CPP is if you're in all of the other provinces except for Quebec, and then QPP is in Quebec. So you want to create a consistent and stable reliable retirement income stream. So looking at whether to take it at 60 or 65 or even 63. Minimizing and reducing your taxes is really important because that's money that could be in your pocket instead of, you know, the government's pocket. So you want to build a tax efficient investment portfolio. Make sure that you're well set up to, you know, weather any of that. You want to make sure that you're reducing your management fees that you're paying, you know, minimizing your costs so that you can keep more of your savings in your pockets. You want to work with an advisor who's a fiduciary. So there's not many advisors in Canada that have a fiduciary duty. It would be someone who's a portfolio manager. I am a portfolio manager and I have a fiduciary duty to my clients. It's someone who has a legal responsibility to make sure that they are acting in your best interest at all times. So I think that that's really, really important because you want to make sure that you're working with someone who's on the right side of the table as you and who's going to do what needs to be done in your best interest. Sometimes some clients I talk to about market timing and, you know, missing out on the growth and upside in the different markets. So whether it's equity or fixed income markets, we're going to talk about that in a little bit. You want to make sure that you're always improving your returns and your bottom line results. So you don't want to just do too much market timing because that means that you can miss the potential upswings sometimes. And then protecting and preserving your portfolio. Again, should we enter into a 2008 market environment, which is basically what we're experiencing right now with the, you know, where the markets have come off quite a bit from their highs, and now we're just, because of all the inflation data and how the companies are performing in general, we're just sort of, we're going up a little bit and then we're coming back down, going up a little bit and coming back down, going up a little bit and coming back down. So it's definitely a tough market environment right now. So you want to make sure that you're managing your risk and preserving your capital as much as possible. I do have a checklist. It's a checklist where if you're retiring 10 years or more from now, there's a little checklist that you can use. So that's you could check that at the end if that's something that you're interested in. And then there's also another checklist, which is kind of that closer 2 to 10 years to retirement that I have available as well. So again, just in the survey at the end, you can mark that you would like one of these checklists, depending on what your current situation is in terms of how long you have until you're actually thinking about retirement. And if you have any questions, I'll just stop for a second and see if anybody has any questions. Let me just see the chat. Hang on. If anybody has any questions, I'll just wait a minute. Okay, it's not popping up. Here we go. There it is. Okay, nope, nothing yet. Okay. If you guys have any questions at all, feel free to put them in the chat and ask away, and I'll try to get to them. I'll pause again in a few minutes to see if there's any questions, and that way I can try and answer. I know I can't see you guys, but if you do have questions, please feel free to ask them, and I'll try to get to them once we have a few more slides that we've gone through. So the basic steps to building your net worth. So you need to have a plan. So having a plan means creating a balance sheet. How much do you spend and how much is left over every month? You want to create a statement of net worth. So what are your assets versus your liabilities? And then the net is your net number, your net worth. So that will determine what your net number is. You want to pay yourself first. So how much can you save and how much should you save to reach your retirement goal? So paying yourself first means saving, so having a budget. So again, going back to that expense worksheet, having an emergency fund. Generally, I say that your emergency fund should be around 3 to 4 months of your net income, which can be a lot to save for, especially if you're putting money in a RSP to reduce your taxes, or you're also saving for kids' education, and just all the general expenses, especially now with the mortgage rates having gone up quite a bit from where they were. So obviously that can be hard too. So just doing what you can and make sure that you have some sort of emergency fund. Having a registered, so investing within a registered retirement savings plan, tax-free savings account, and then having just a reinvestment program within those plans. The next thing is that you want to set your objectives. And what I mean by that is, what are the kind of goals that you're aiming towards? So if you're going to be retiring, obviously you want to have a retirement plan. If you're going to be buying property, are you going to be downsizing your current place? Are you buying a second property? I'm not sure. But if anything that has to do with real estate, like obviously you want to have a plan with that too. Tax planning, age 71 is kind of like that tax bomb. And what I mean by that is, once you turn 72, you have to convert, well, you don't have to, you have other options. You can turn it into an annuity. But generally speaking, you would turn your RSP, retirement savings plan, into a retirement income fund. And once it is a retirement income fund, you would have to draw down a minimum percentage every year based on your age. So if you saved, I don't know, $1 million into that plan and you had to withdraw 8%, then already that's $80,000 a year of income, which could put you in kind of a higher tax bracket. I have also what's called the Wealth Planning Facts and Figures for 2023, which outlines what the CPP is, QPP, old age security, what the clawbacks are for old age security payments, like what your income levels would be and what those clawbacks would look like. And also what the TFSA contribution limits, the RSP contribution limits, all that kind of stuff. So if that's something that you're interested in, you can include that in the survey response. Estate planning as another goal. So when was the last time you updated your will and powers of attorney? So the use of a corporate executor can come in really handy sometimes as well. Trust planning, so family trusts, spousal trusts, alter ego trusts, gift planning, legacy planning. So donor advised funds have become really popular. Donating appreciated securities, setting up a legacy. So as an example, the McGill Women's Alumni Association Scholarship Fund is a good example to that. So what are your goals? Sorry, I see a question about this tax bomb here. What is the tax bomb? Yep, as I was mentioning, once you turn 72, when you convert your RSP, so your retirement savings plan, into a retirement income fund, that can substantially increase the amount of taxes that you'll have to pay if it's a large withdrawal that you have to make from that plan. So if you had $1 million saved in there and you had to take out 8% because of your age, then that would be $80,000 just from that. So then you've also got the QPP or the CPP as income. So if you add all that in, all of a sudden you're in a really high tax bracket when you're retired. So that's what that tax bomb is. I see that there's been quite a few questions come in, so I'll just pause for a minute just to answer some of these. There's nothing that says that you have to have a financial advisor. One can try to invest on their own. Yep, yeah, by all means, you can do online investing. What should be used? Sorry, this doesn't. Not sure that made sense. I think what the person's asking is, should you use your RSP first or a defined benefit plan? Maybe that person could just resubmit that question. I'm not sure. I'm not sure what that person means. Different acronyms and vocabulary. Is there a document or a website that can talk about what the different acronyms are? So RIF is a retirement income fund, tax-free savings account is a TFSA is a tax-free savings account. There is, I think it's Investopedia. So I think if you just type that in, and then I can give you what the different acronyms are on that website. What is the tax bond we talked about? A trust is basically it's a separate entity that clients that some people use for tax planning or just family planning. And it gets put into there, and basically it could be upon death of a spouse or of parents, and so the money is managed within what's called a trust, which is its own separate entity. It has its own tax rate, and it has its own tax filing every year that needs to be done, and so it just has different tax system altogether. When should someone think about creating their first will? I mean, really, I think everyone should have one, but especially if you have any assets, so financial assets, savings accounts, plans, any property, especially if you have children, it's really important to put in there, especially if they're minor, to put in who their guardians will be in the event that something happens. But really, anytime you have any kind of property at all, you should probably have a will, because you want to make sure that if something happened to you, that you would have it you know, properly managed. What is fee for advice? Is it based on portfolio value? Generally speaking, yes. I'm going to cover what different management fees are at the end, but generally speaking, you know, advisors charge a management fee based on the size of a client's portfolio. Or if you do online trading, then it's a fee per trade. So it could be like $9.99 a trade if you're doing it on your own online. And then some financial planners also just charge a flat fee for to do like just a financial plan, and then you can manage your assets on your own separately. So it just really depends on the structure that the advisor that you're working with has. The different trusts that I went over, I'm happy to send them out. If that's something that you want more information on, I can send out information on it. Should you use cash first, RSP, or DCCP first? I'm not sure for what, I'm not sure using cash or RSP or DCPP first. I'm not sure for what. An annuity is an option for people who don't want their RSP to roll over into a retirement income fund. It's an insurance product, so I don't know a lot about it. I'm not an insurance advisor, but I believe that you just, I believe you take the amount and then you buy an insurance, an annuity with it, and then it just pays you out every single year based on the value of your account, and then it gives you like a set monthly income every single year. And I'm not sure what kind of rates they use now, because interest rates are higher than they were, but generally speaking, that's how it would work. Okay, so it looks like there's lots more questions coming in. So what I'll do, just in the interest of time, is I'll continue with the presentation, and then I'll answer the questions again shortly. Or maybe just at the end, keep putting your questions through, and then I'll just maybe answer them at the end, just to make sure we have time to go through the rest of the presentation. Okay, so developing a retirement plan. So the three, just like generally speaking, the three primary sources of retirement income would be government plans, so the CPP, QPP, old age security, company pension plans, personal savings, so like an RSP or a TFSA, where you would convert it into a RIF or LIF, depending on if it's a locked-in account or a regular account. Replacing today's income. So I used a 5% inflation rate. I know we talked about inflation earlier, and basically just wanted to show you what that looks like using 5% inflation. So if your income today was $60,000, then to replace $60,000 today, 20 years from now would be the equivalent of $159,000. So just making sure that you do factor in inflation when you're doing your planning. I just thought I would include this graph here. The advantages of an RSP as well are that when you make a contribution to the plan, they are tax deductible against your current income over time. Some of the rules to live by when we talk about retirement planning is like open a registered retirement savings plan account, contribute your maximum if it makes sense from a tax perspective, contribute early enough each year if you can, because there's tax deferred compounding when you invest within these plans, or monthly. Sometimes I find that monthly really works a lot for clients because you can just set the monthly amount that comes out of your bank account. You can link it to whenever you get paid, and you just know that that money is going into your savings. And then investing wisely is important too. So the 2% difference. So this is a graph that just shows $5,000 a year has gone into a plan that grows tax-free. And at the end of year 5, if the if the return was 6% per year, your plan balance would be $29,877. And if you had a 10% return, then it would be $33,575. Obviously, the more extreme scenario of that is you would have to have consistent returns for 35 years, but 6% for 35 years would be $590,000. Versus at 10% would be 1.4 million. So it's just making sure that you're paying attention to those returns. It's obviously important too. The tax-free savings account was introduced in 2008 by the federal government. You're allowed to contribute a maximum of $6,500 per year as of this year. If you've never opened one before, you can contribute $88,000 today if you turned 18 before 2009. But there are some rules when it comes to the tax-free savings account, which I'm not sure everyone's aware of, but it is important not to over-contribute because the CRA has very strict rules about that, and they have penalties, and they track it on their own. And those penalties can be kind of a little bit hefty sometimes. And then if you contribute, really where the confusion comes from is contributing, withdrawing, and then contributing again in the same year. That's where some challenges seem to arise with the CRA. So I would just say if you're going to withdraw 1 year, then just wait until the next year to actually start again, just so that there's no confusion about penalties or what's been put in or not with the CRA. If you want to know what your unused contribution room is too, you can go on CRA's website, go to your account, and you can see on there what your unused TFSA contribution is. On here, I just had a TFSA versus an RSP. So I had marginal tax rate of 40% when the money was contributed, and then 40% when the money was withdrawn. So obviously in this case, at 40%, it doesn't make a difference whether you're doing it in the TFSA or the RSP. But where it does make a difference is if you have a 40% tax rate when you contribute, and then 20%, so a little bit lower when you're withdrawing. You get a bit more bang for your buck with your RSP because you get that you get the money back from the CRA on your income taxes. So there is a little bit more juice, as they would say. And then obviously where it makes more sense to have the TFSA is if you have a lower tax bracket, lower tax rate. When you're contributing to both plans, it makes more sense to use the TFSA than the RSP. I have this because I always get a lot of questions about should I invest in a tax-free savings account or an RSP? And the answer really depends on what your tax rate is. So what your marginal tax rate is, how much are you going to get back from the government by putting money into your RSP, and you know, what's the net income going to be for you down the road. Also get a lot of questions about how long money will last. So I put this example in here, how long will $250,000 last? So if you retired now versus 2 years from now, so sometimes it can make a difference. In this case, it would make the money would last for an extra 5 years. So at a 6% rate of return, and you're taking $18,000 a year out, but you waited an extra 2 years, the portfolio will last an extra 5 years based on that 6% rate of return. So you're kind of asking yourself, like, does it make sense for me to keep working an extra few years? The answer usually is yes, it usually makes sense. But again, it really depends on your unique situation, and maybe, you know, maybe it's not worth it for you personally to do that, but that's just an example. So you want to create and manage your investment program. So I'm just going to see if there's a lot more questions that came in. Hang on. Whoops. All right. Yes. Okay, so what I'll do is I have a few more slides to get through, and I'm just going to save these until the end because we do have to finish by 1:30, and I want to just finish I'll just finish these slides for you, and then we'll get through to all these questions. So creating and managing your investment program is important because it directly impacts what your retirement is going to look like. So what are your needs and objectives? So you have yourself right now a current financial picture. Generally, you want to make sure that you understand what your risk tolerance is. How long, like time horizon, how long do you have until you need to start drawing on your capital? So what's your time horizon? What's your knowledge when it comes to the to investing? Is it good? Is it limited? Is it excellent? What's your time commitment? How much time do you want to spend on it? And you know, what are your goals? So just in general, we have short term, which would be less than a year. We have fixed income, which is bonds and preferred shares, and then common stocks. Common equity, which is stocks. So when we talk about short term or very like risk-free investments, would be treasury bills. And then GICs are locked in, so they pay interest and they're available in terms of 1 to 5 years. And they're called guaranteed investment certificates because the capital is guaranteed. I'll just skip this because it's not that important for this. Then there's government and corporate bonds. So there's straight bonds, which pay interest twice a year. There's strip bonds, which are sold at discounts, and you don't actually get interest payments on them, but you get paid at the end of the term of the investment, or you can sell it sooner actually. But that's usually how the strip bonds work. They're much better inside of like an RSP, for example, instead of a non-registered account, just because you end up getting quite a big capital gain. But anyway, that's just one type of investment. And then there's the mortgage-backed securities. Preferred shares, which is also a fixed income investment, which are supposed to be less volatile, but they are, to be honest, very much tied to interest rates a lot of the times. So they historically, sure, they've been less volatile, but we've seen sort of 2 different periods with preferred shares where clients who wanted to have more fixed income than, you know, common equity have been really disappointed about how volatile they've been because the prices have moved more than their common stock in the portfolio. They do pay regular dividends, so they are more tax effective than buying bonds in a non-registered account, and they do come with a credit rating, so that is important. But just to be mindful that they can be more volatile than you'd like. With common stock, you do get ownership in the company, and then you have dividends that are generally paid from the companies. I tend to focus on companies that pay dividends because if the markets are down, or you know, there's going through a period of volatility like we're seeing right now, at least you can get paid to wait, paid while you wait. And then you get that capital appreciation potential as well. So when talking about asset mix, it's basically how much percentage of your portfolio are you going to have invested in stocks versus bonds, and then cash. And why it's important is there's really a strong influence between the risk-reward trade-off, and it really has to do with your asset mix. And it's the really the best way to try and reduce any kind of volatility that's kind of keeping you up at night. You know, if you're seeing a lot of swings on your statements right now and it's making you feel nervous, then that's a good indication that maybe you don't have the right asset mix. This is just a chart to show you that when the markets go down substantially, they do come back up historically. And then I have in here just this performance benchmark, which is just to show that obviously last year was a very negative year for the markets, both fixed income markets, so bonds being the safe place to go, were not so great last year. And you know, the US market, Canadian market, everything was down quite a bit last year. So the bond market last year was down just about 12%, which really made a lot of clients scratch their heads about that. And then the Toronto Stock Exchange was down almost 6%. And then the US market was down 18%. So, well, that's the S&P 500. So last year was a pretty negative year, but this year we're seeing things look up a little bit better. So diversification does reduce risk. So having, you know, 30, 40 names in your portfolio can reduce the risk, but having more than that may not increase your returns that much. Diversification can be by asset type, industry, country. So common stock, bonds, industry would be technology, financials, industrials, and then by country. So Canada, US, etc. I do have, actually, I just got released. It's for February 2023. It's our equity and fixed income strategy, and it talks about how right now we're increasing our Canadian equity weighting by 5%. So if you're interested in reading this, please let me know and I can send this out as well. When you fill out the survey, you can just put that you'd like the equity and fixed income strategy as well. Just a quick note on responsible investing. So I get a lot of questions about responsible investments, and basically it's really investments in companies that are very mindful of their environmental impact. So generally what you wouldn't have in a portfolio would be energy and materials companies, would not be in like a sustainable portfolio. But there's a lot of other great companies that would be, and they are rated on the MSCI. There's this global sustainable investing portfolio that we have, and there's this MSCI World Index. And last year, that World Index had a total return of 6.3%, which significantly outperformed what most of the markets did. So that was good. Some of the names in that portfolio are like McDonald's, which is interesting, and Xylem, and some other names. So if responsible investing is something that's of interest to you, let me know and I can send this off as well. And then when is the right time to invest? Again, questions that we get from clients lots of times. Some of the risks of market timing are, you know, missing those possible upswings, and then if you are invested in a non-registered account, obviously having those taxable capital gains. We do recommend to buy value, buy dividend-paying companies so that you get paid while you wait, like I mentioned before. And then it's just really important to take a long-term perspective on your investment portfolio. Some tax considerations if you're investing outside of a TFSA or RSP where there's that tax-deferred compounding is that you want to basically pay off, dividends versus interest, obviously. You want to pay off any non-investment related loans as best you can, and then you want to try and defer those capital gains when you can. Okay, so we're almost at the end. So if you have more questions, please put them through the chat and I'm going to try to get to them over the next 15 minutes. So selecting an advisor. So you want to, obviously at the beginning I mentioned working with a fiduciary, someone who has a fiduciary responsibility is important, but you want to maybe ask your family and friends for recommendations. You want to ask what your advisor's service model is like. So what are your expectations? You know, do you want to review your portfolio once a year, 4 times a year, once a month? I'm not sure, but you know, making sure that those expectations are being met. You probably want to interview a few different people to make sure it's the right fit for you, and then you want to understand what the costs are. So management fees versus commissions can be important to understand as well. Some of the services that should be provided by your advisor, especially if you're paying a management fee and you're working with someone who is kind of helping you figure out everything. So you want to have financial planning, wealth planning as a service provided by your advisor. You want to have help with setting goals and objectives. You want to be provided with investment research and advice, and obviously asset management. And progress reports would be, you know, monthly statements, portfolio reports, performance reports. You want to get financial updates and also have those portfolio conversations, I think a few times a year. Every month is a bit much because not enough changes every month, but I think a few times a year makes sense. And then what are those service expectations? So what does that look like? So some of the resources that we talked about were the wealth planning facts and figures, the retirement expense worksheet, and then the checklist with it, which is there's one that's 10 years and more for those who are going to be a bit further away from retirement, and then 2 to 10 years to retirement, and then equity and fixed income strategy research that I mentioned. I also touched upon the sustainable investment portfolio that we have that I can send as well if that's something that you want to look at. But either way, the survey, so if you just put your camera to the screen and basically it'll pop up with a link for you to fill out, and you can put that information that that's what you would like in the survey. So just going back about these great questions that everyone's asking here. So does an annuity have to be created by age 71 or at age 71? Generally speaking, the decision gets made to go from an RSP to either a RIF, which is a retirement income fund, or an annuity around that 71, 72 year mark. You can convert your RSP into a RIF before then, and you can also use it to buy an annuity before then as well. That the maximum age limit that you can have an RSP open is until the age of 71. When retiring, should we withdraw from the RSP first or wait until 71? I mean, generally speaking, if you have enough cash flow that you can live off of without drawing on your investments, really depends on the situation, but generally, if you can wait to withdraw on it, then by all means. But if you need to start drawing on your investments once you do retire, then yes, withdrawing from the RSP would make sense. Also, withdrawing from the RSP, just as a note, means that is taxable. So whether you're waiting until you're 71 or not, when you take money out of your RSP, that is taxable. Like, you do have to pay income taxes on that. So just to make sure that you're aware of that. Do you have more specific information on trust and legacy planning? There's not like any checklists available for those. Those are more advanced strategies that we talk about with clients. But if you have a specific question or want specific information on it, please feel free to fill out the survey and let me know what your question is, and I can try to answer it to the best of my ability. Actually, my contact information is here too if you need to email me. What is the minimum percentage required by the government to withdraw from an RSP at age 72? I think it's about 8% a year, maybe it's lower. You can actually, if your spouse is younger than you, you can assign their age as well, which is a common strategy that gets used. But that would be in my wealth planning facts and figures. I can look that up after. What is a good retirement disbursement plan if you have an RSP, TFSA, QPP? A good retirement disbursement plan would be making sure that you're minimizing your taxes. So having a good balance between those two options, and then using the QPP as your monthly amount. So it really just depends on how many, so what your different sources of income are, what that all amounts out to when you add it all in, just to make sure that, you know, maybe 1 year it makes more sense for you to withdraw more from the RSP and less from the TFSA, so you can keep that handy for the next year. It really just depends to see what your tax situation would be like at that time. How much tax do you recommend that the corporate pension plan, CPP, and OAS withhold? How much tax do we recommend that those pension plans? I think that would be more of like a CRA question. I'm not sure if there's an option to withhold additional amounts. You can withhold additional amounts with your own personal savings accounts, like with your RSP, and if you have a RIF, when you're withdrawing from there. So I'm not sure if you can do that with the pension plans, to be honest. Do we have any advice for women who retirement and parenting are more closely linked, specifically for women who are having children in their mid-40s, where retirement age and planning is also coupled with children? I mean, I'm happy to take that offline as well if you want to send me an email or fill out my survey. We have many clients who are women who are having children in their mid-40s, where we're working out plans to, you know, save for retirement at the same time as saving for education at the same time. I would say that at the end of the day, it's a balance, and you need to figure out what makes sense, what makes the most sense for your monthly, for it to be balanced on a monthly basis for you. Someone mentioned using different types of insurance and getting premiums back. Is this a good strategy? It can be a good strategy. I know, like if you buy like a critical illness plan and then you don't end up using it by a certain age, you can get your premiums back. I'd say it's a good strategy in the sense that if you need critical or you feel more comfortable having critical illness insurance, then definitely that could be a good plan, but I wouldn't do it just so that you can get the premiums back, because you could always invest the money that you would put inside of those for the premiums themselves, and maybe the money would grow faster that way too. Is 5% inflation a realistic number? I realize that inflation has been very high recently, but the average over the last 20 years or so is 3.8%, I believe. Yeah, as I mentioned, I used 5% inflation just because we're seeing very high inflation right now. It's not the number that we're using for our plans. We're still using 3% inflation, 3.5%. I hope 5% is not a realistic number, but I just used it as an example to show that when planning for retirement, it's just really important to take into consideration what inflation looks like right now. When you retire to pay rent and other expenses, is it better to use saved up cash or start withdrawing from your RSP to pay your day-to-day expenses or your pension plan? I'm not sure if you can actually withdraw from your pension plan until you convert it into what's called a locked-in fund. So that would depend if it's accessible, you know, to you right now or not. But again, just going back to the withdrawing from the RSP can be taxable. So just making sure, like if you've earned income for the whole year and then you're drawing off of your RSP and then you're basically increasing your annual income because of that, maybe it would make more sense to use cash, like saved up cash. So it really depends on the tax situation, but I'd also check to see how accessible the pension is. Do you have to turn it into like a life income fund, or is it available to you now? I am familiar with GICs, but haven't heard of treasury bonds. How can they be purchased? What role they could have in a portfolio? Yeah, treasury bonds are they're available like through a broker basically. They do offer very low interest rate. You would be better off buying like provincial bonds and GICs and just regular bonds, to be honest. they are risk-free investments. They would be available like at any brokerage you could buy them through. If the market is down, is it a good time to buy stocks and bonds? Generally speaking, if the market is down, it's always a good time to average in. Yes, it is usually a good time, but it doesn't mean that the market's not going to go down further. But generally speaking, if the market is down, it's a good time to invest. Preferred shares are they're a fixed income instrument that have preferred ranking for credit purposes. It's corporations that issue them that trade on the stock market, but the preferred shares would have in a bankruptcy situation, preferred shares would be higher on the list than the common stock payouts. And they pay dividends, so they can be really tax effective in a non-registered portfolio. And they can be quite volatile, like their prices trade on the market, so they can be a bit more volatile than the price of like the bonds, for example. And they are closely linked to what interest rates are doing, so just to be mindful of that when you're buying the preferred shares. How do we know who has a fiduciary? Is it a certificate? It's not a certificate, but they would have what's called the Chartered Investment Management designation, or they would have the CFA, which is the Chartered Financial Analyst designation. So the CIM or the CFA would be a good way to see if someone has a fiduciary duty. And then if they use the title of portfolio manager, if you're a portfolio manager, then that means that you have either the CIM or the CFA, and you've been approved to act as a fiduciary. And the next question is, are all BMO advisors fiduciaries? No, I think maybe 10 or I'm not sure what the percentage is, but it's a small percentage of advisors that have a fiduciary duty for their clients. Okay. If there's anything else, please feel free to email me or call me or fill out my survey, and make sure to stay connected with the McGill Women's Alumni Association for upcoming events, and anything that I can help with, I'm happy to answer. Thanks again to the McGill Women's Alumni Association for having me come today. I hope you found this useful and informative. Thanks again.